On December 11th, Bloomberg reported something unprecedented. For the first time ever, India has officially allowed gold and silver inside its national pension system. Let that sink in for a moment. This is not retail buying. This is not jewelry demand. This is institutional, government-regulated retirement money entering precious metals. India is already one of the world's largest physical gold buyers. But this move is different because now gold and silver are entering the financial system itself, and once that door opens, it rarely closes. Under the new rules, India's national pension system can allocate around 1% of assets into gold and silver. That alone represents up to $1.7 billion of potential new demand. And remember, this is just the beginning. Today, it's 1%. Tomorrow it could be 2, 3, even 5%, especially if gold and silver continue doing what they've been doing. Gold is up 61% this year. Silver is up an astonishing 114%. This is not hype. This is not a meme trade. This is a signal. And when governments and regulators start adjusting rules after prices already moved, it tells you something very important. They're reacting, not leading. Earlier this year, China allowed insurance companies to allocate up to 1% of their assets to gold, over $27 billion at the time. Now India follows. When the two largest populations on Earth, the two biggest gold-loving cultures, both move toward gold inside their financial systems, that is not coincidence. That is trend confirmation. Now, I'm not an ETF guy. I prefer physical gold and silver. But here's the reality most people ignore. ETFs still require a physical metal behind the scenes. You may not take delivery, but someone, somewhere, must supply the bullion. And that creates pressure. Slowly at first, then all at once. This is where most people get it wrong. They zoom in too close. When you look at gold on a monthly chart going back to the 1990s, the trend is crystal clear. This bull market is intact. Volatility doesn't mean weakness. It means currencies are losing value. Gold just printed the highest weekly close in history, around 4,300 spot. And yet people are calling a top. Funny thing is, the loudest top callers are usually the ones who missed the entire move. Silver also just recorded its highest weekly close ever. The all-time high was around 64.66, and we closed just under 62. That's not weakness. That's consolidation near historic levels. The gold-silver ratio has broken major support. We're now below 70 on a weekly basis. Last time we saw levels like this, silver went into a powerful run. My next major target, around 62, the level we saw during the 2021 silver squeeze. Even more interesting. Silver just broke out against the S&P 500. That means silver is quietly outperforming stocks, and most people haven't even noticed yet. GDX just printed its highest weekly close ever around 80. Yes, we pulled back slightly. That's normal. Markets don't move in straight lines. Trends breathe. Nothing has fundamentally changed. Central banks must inflate. Debt is growing every second. In 2026 and 2027, massive amounts of debt come due, and there is no possible way to pay back over $300 trillion in global debt. It will be rolled over, printed over, inflated away, and gold and silver exist for this exact reason. Watch the bond market not just in Japan, not just in the US, but also in Germany. The signals are flashing red. So when you hear people calling tops, remember this: big money is only just starting to move. Enjoy the rest of your weekend. Stay grounded. Think long term. Take care.